The Monetary Policy Committee sees the downward inflationary trend as positive, but still above the policy reference band. It is pleased with existing naira stability across all segments of the foreign exchange market and prospects of foreign exchange inflows. It, however, feels loosening its current stance will worsen inflationary pressure and reverse the naira's gains. Tightening, on the other hand, could widen the income gap, depress aggregate consumption, and affect real sector credits.
MPC decided to 1. Retain MPR at 14%, 2. Retain CRR at 22.5%, 3. Retain liquidity ratio at 30%, and 4. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR.
Economic watchers have criticized this monetary policy stance, saying it does not complement recently unveiled economic reforms by the fiscal authorities. They feel a reduction in key rates will help enhance credits to the real sector at this time. But the committee says its actions are in line with prevailing economic conditions.
Indeed, it's not only manufacturers that have called for a low interest rate. Even me, I want a very low interest rate. But the economic aggregates that is usually presented to us, or that we see today, unfortunately does not give room for us to begin to look at that direction of signaling a further downward trend in interest rates.
The Apex Bank maintains that the country will exit recession by the third quarter of this year. It advises that the budget be urgently assented to and implemented for the success of the economic recovery and growth plan. It as well advises deposit money banks to improve on credit flows to the private sector. Lara Folayo, TVC News, Abuja.
Well, that's business at this time. It's back to Mike and Ngozi.
Thank you, Yemisi, for the updates there. Lots and lots, especially coming from the Monetary Policy Committee the meeting. A lot Nigerians are expecting that all of this retainment of figures and interest rates and all of those will translate into that difference. Because,
and I actually wonder for how long the CBN can retain this rate.
And that's the question, and that's exactly where we're taking our next discussion to right now. Joining us from Abuja studio is Associate Professor and also Head of Department, Banking and Finance, Nasarawa State University, Uche Uwaleke. Good morning and thanks for joining us. Okay, now,
morning.
so
thank you for inviting me.
Yes, indeed. Now, the MPC has come out, well, with nothing new, so to speak, retaining 14% interest rates. CRR, that's the cash reserve ratio, remains at 22.5%, and liquidity ratio remains at 30%. They're saying inflation worries have advised this move. What's your take on this?
Yeah, thanks very much. You notice all the 8 members that were in attendance voted for, maintain the status quo. That is returning the MPR at 14%, as well as other policy rates, cash reserve ratio at 22.5% and liquidity ratio at 30%. That goes to tell you that the CBN is concerned about its primary mandate of maintaining monetary and price stability, talking about the 3 prices, interest rate, inflation, and exchange rate. Of course, we know it's difficult to pursue the 3 at the same time. But of course, you also know that one of the arguments for not reducing the MPR, that even though inflation rate is backtracking, the headline inflation from 17.26 to 17.24, in April, the food index component, actually rose. The reduction we saw was more from the core component, and the CBN is also scared that the base effect that are also partly responsible for the reduction, will soon come to an end. So CBN is conscious of, ensuring that the gains are not reversed. The same too goes for the exchange rate. There is also the fear that if the MPR is dropped from the current 14%, that it may lead to an elevated demand pressure in the forex market, and again reversing the relative stability we are currently experiencing there. So these are majorly the reasons the MPC decided not to drop the rates. Again, they also cited the issue of the widening. If they drop the rate, of course, they will widen the negative real interest rates, that we currently have. There's also the consideration of a further tightening of monetary policy. That was also on the table. But of course, that will clearly portray the CBN as being insensitive to, growth concerns.
Okay.
There is also the issue of the effect it's going to have on the banking sector. The issue of non-performing loans. If you further tighten, the banking resilience we're experiencing now, will further weakened. It will be difficult for them to extend credits. Even the CBN noted, the MPC noted that right now it's difficult for banks to lend money to the real sector. So there is credit concentration, and that's because the CBN is the deposit money banks are more in favor of
all right, Professor Wale,
the government.
Yeah, Uche, let me ask this. In this retainment, a lot of Nigerians are expecting that conscious effort should be made, especially when it comes to policies and strategies to get Nigeria totally out of recession. In this retainment, how is it going to help in that direction? Because Nigerians expect to see something different, something drastic.
Yes, my wish too. This is also my wish that we should pursue a low interest rate regime. That is the wish of I'm sure most Nigerians. But again, the reality is with us, and let's face the facts too. Sometimes I give it to them because the CBN as an institution, is in a stronger position to have superior information, over and above what you find individuals have. I'm sure they have done their research. The Monetary Policy Committee has a monetary policy, technical committee, that supports the committee with, research findings. So to that extent, I would give it to them. But I said my wish would be that we have a low interest regime. Look at even the cost of borrowing. In 2017 alone, we budgeted 1.84 trillion on debt servicing. And that's because the bulk of our debt, which we hear is around 17.5 trillion naira, the bulk of our debt is largely domestic. And we spend so much servicing these debts, and that's because, again, the interest rate in the economy is very high. Government borrowing sometimes as high as 18%.
Yes,
treasury bills. The
okay,
FGN bond pays as high as 13%. So the cost of government borrowing is high, and that's partly because of the high interest rates we are facing in the economy. So a lower interest rate regime will ensure that, at least from the point of view of government borrowing, it's reduced. That also goes to speak
all right,
for even
Professor Uche Uwaleke will have to say thank you very much. Of course, manufacturers are calling for lower lending rates and all of that. Not enough time to dwell more on this, but we appreciate your time and, of course, your insight. Uche Uwaleke is Head Department of Banking and Finance at Nasarawa State University. We'll take a short break, and when we come back, it will be time for the news update and, of course, sports will be here. Stay with us.